All right, let's get right into it. Today, we're not just looking at another REIT. We're tearing down National Storage Affiliates Trust. But forget the usual earnings per share analysis. We're throwing out that playbook and applying a much sharper lens, the theory of the capital cycle. Time for the teardown.
So, to figure out where NSA is headed, you have to know where it's been. And where it's been is at the heart of a massive supercycle. The pandemic created what some have called a freak phenomenon of demand for self-storage. Occupancy went through the roof, rental rates skyrocketed, and NSA was right there to catch the wave. But the big question, the one that really matters now, is what happens when a freak phenomenon ends? What happens when gravity decides to make a comeback?
Now, you've probably heard the bull case for NSA. It's always been incredibly simple, almost seductive. Here's this smart consolidator in a super resilient industry, right? An industry that basically profits from life's big, messy transitions, the 4Ds as they call them: death, divorce, downsizing, displacement. The story of rolling up a fragmented market of mom-and-pop shops sounds great, but as you know, the easy story is almost never the whole story.
So to really get under the hood and understand the risks here, we have to ditch that simple narrative. We're going to apply a much more rigorous framework, one that doesn't get distracted by rosy demand forecasts and instead focuses on the cold, hard math of the supply side.
And this is the absolute core of our analysis today, the capital cycle. The theory is, it's elegant in its brutality. High profits, like the kind the storage industry saw during COVID, they act like a siren's call to new capital. That money floods in, it funds new construction, and pretty soon you've got oversupply. And what does oversupply do? It absolutely crushes returns for everybody. It's a supply-side story that everyone seems to forget when times are good.
And we're going to layer another concept on top of that, the asset growth anomaly. Look, the data on this is overwhelming. For decades, there's been this weird inverse relationship between how fast a company grows its assets and how its stock performs later. Companies on a buying spree, sound familiar, tend to chronically underperform. So when you look at NSA's aggressive acquisition strategy over the past few years, well, it starts to look like a textbook setup for future disappointment.
Which brings us right to our central thesis. The argument here is that NSA isn't what the simple story says it is. It's not some unique generator of structural alpha. What it really is a leveraged cyclical play. And it looks like it's been caught on the completely wrong side of a very powerful wave of mean reversion. So let's get to the evidence. Okay, so if the thesis is that NSA is not a special alpha generator, then the first thing we have to do is attack the moat. What is its real competitive advantage? To really test it, you got to put it up against the best in the business. And this is where the cracks really start to show.
Just look at the difference here. NSA's moat, for years, was basically financial arbitrage. They used their public stock as a currency to buy private assets for cheaper. It's a great trick in a bull market with a low cost of capital. You could call it a fair weather moat. Now compare that to a logistics monster like U-Haul. A staggering 25% of its storage customers come directly from its truck rental business. That is a deep, structural, low-cost customer acquisition funnel that NSA simply cannot touch.
Then you've got the industry giant, Public Storage, or PSA. Think of it as a centralized data machine. Its insane scale gives it a proprietary lake of data that lets them algorithmically price their units with surgical precision. And NSA? Its whole model was built on this decentralized federation of participating regional operators, or PROs. It's a complex structure that, you could argue, creates diseconomies of scale, more friction, more complexity, and a persistent nagging gap in profitability.
Okay, so that brings us to the ultimate test of any management team: capital allocation. Because now that the cycle has turned, NSA is navigating in a world with financial gravity again, and the choices they make right now will decide everything.
And the pressure is just immense. Let's start with this number, 100%. As of the third quarter of 2023, their dividend payout ratio on core FFO was 100%. That means every single dollar of cash flow went right back out the door to shareholders. There is zero margin for error here. No cushion for reinvestment, no room to pay down debt. It is a company walking on a razor's edge.
And at the exact same time, the balance sheet is seriously stretched. We're talking 6.7 times net debt to EBITDA. To put that in perspective, a fortress like Public Storage usually runs around 4 times. This isn't just a number, it's a strategic straitjacket. High leverage kills your optionality and makes it almost impossible to play offense when things get tough. And remember that operational gap we talked about? It is persistent, and it is severe. we're looking at a 900 basis point. That's a full 9 percentage point gap in net operating income margin versus public storage. So the billion-dollar question for any investor is this: is that a gap they can actually close? Or is it a permanent feature because they just own lower quality assets? The answer to that question changes everything for the long-term value.
This chart basically tells the entire valuation story in one picture. Back in 2021, you had a world where you could buy a storage property at a 4.5% cap rate while the 10-year Treasury was paying 1.5%, a nice, healthy spread. Now, fast forward to today's reality, the public market is pricing NSA's portfolio at an implied cap rate that's closer to 7%. That massive shift implies a huge write-down in the value of their underlying real estate, and for a company with this much debt, that pain gets magnified big time.
So management is facing a classic trilemma. What do? Option 1, keep growing aggressively, basically ignoring the asset growth anomaly and almost certainly destroying value. Option 2, go into a defensive crouch, stop buying, pay down debt, but kill the growth story that propped up the stock for years. Or option 3, capital recycling, start selling assets to buy back their own stock. From a capital cycle perspective, this is the most bullish move, but let's be honest, it takes a kind of discipline you rarely see from management teams that are used to building empires.
So, after all that, the theory, the comparisons, the numbers, where do we land? We've got to bring all these threads together and ask the big question: is this stock a bargain, or is it something much more dangerous?
Okay, let's just run through the bear case one last time. The moat? It's eroded. The unique structure that fueled its rise is now a liability. The growth engines, both the internal and the external ones, are sputtering. The earnings, they're very likely at a cyclical peak and poised to fall. And all of this is sitting on top of a highly leveraged balance sheet. You can see how each one of these problems just makes the others worse. It's a really precarious setup.
And so it all boils down to this one final question. Do you look at NSA and see a deeply discounted, leveraged bet on housing recovery? Or when you factor in the capital cycle, the asset growth anomaly, and its weakened competitive position, do you see a classic value trap? A stock that looks cheap but is probably cheap for a very good reason? That's the question you have to answer.